Here's what's messing with every investor's head right now. Companies are reporting record earnings. Nvidia just delivered revenue of $68 billion, up 73% year over year. Salesforce beat expectations. Dell surged 21% in a single day. By every traditional measure, corporate America is performing. And yet the S&P 500 is flat for the year. The Nasdaq is down nearly 6% from its October highs. The Dow had its worst single day in a month just last week, dropping over 820 points. Microsoft is down nearly 18% in 2026. The so-called Magnificent Seven, the group that drove the bull market for 2 straight years, is mostly in the red. So, what is going on? Why is the market falling when earnings are strong? That is exactly what we're breaking down today. There are 5 distinct forces at work right now. And once you understand all 5, the market's behavior stops looking irrational and starts making perfect sense. Let's go. The market prices the future, not the present. The single most important thing to understand about stock markets is this. They are not a scoreboard for past performance. They are a pricing machine for future expectations. When a company reports earnings, the market isn't reacting to what happened last quarter. It's asking, does this result change what we expect to happen over the next 12 to 24 months? If the answer is no, if the results were already priced in, the stock can fall even on great numbers. This is exactly what happened with Nvidia on February 26th. The company reported record revenue of $68.1 billion, up 73% year over year. Adjusted earnings per share came in at $1.62, up 82%. It beat analyst estimates on both the top and bottom lines. By any historical standard, this was a spectacular quarter. The stock fell anyway, dropping more than 5%, as skepticism took hold among investors who questioned whether Nvidia could sustain such elevated growth. The motley fool. Why? Because the market had already priced in a great quarter. Investors weren't surprised. They expected it. What they're now asking is, what comes next? Can Nvidia keep growing at 70% plus? Can its customers keep spending at this pace? Those questions don't have clear answers, and uncertainty gets sold. That's point 1. The market doesn't reward what happened. It rewards what surprises to the upside. Now, let's talk about valuations, because this is the foundation that makes everything else more dangerous. Going into 2026, the S&P 500 was trading at a forward P/E ratio of 22, meaning investors were paying $22 for every $1 of expected annual earnings. That's elevated compared to both the 5-year average of 20 and the 10-year average. But it gets more striking when you look at the longer-term picture. The S&P 500 recorded a CAPE ratio above 40 in January 2026, a very rich valuation that is historically correlated with a 30% decline over the following 3 years. The CAPE ratio, the Shiller cyclically adjusted price-to-earnings ratio, smooths out earnings over a 10-year period to remove short-term distortions. At 40, it is near record territory. The only comparable periods in modern history were the peak of the dot-com bubble in 2000 and the COVID-era market frenzy of 2201. The Buffett indicator, which compares total stock market capitalization to GDP, now sits at 223%, dwarfing the dot-com bubble's 150% peak. Financer. Here's why this matters in the current context. When valuations are this stretched, the market has zero margin for error. Every piece of bad news, inflation data, a tariff announcement, an AI concern, hits harder than it would in a normally valued market. The higher the multiple, the longer the fall when sentiment shifts. Think of it this way. If you buy a stock at 15 times earnings, you have a cushion. You can absorb some disappointment. If you buy it at 40 times earnings, you've essentially borrowed against the company's best possible future. Any deviation from perfection gets punished immediately and severely. Multiple stock market metrics with a history of predicting downturns are currently showing red flags. The S&P 500 Shiller CAPE ratio is at nearly a record high. And historically, higher metrics suggest prices could fall in the coming years. The strong earnings we're seeing are real, but they're real inside a market that was already priced for exceptional earnings to continue indefinitely. When the future looks even slightly less certain, enter tariffs, enter AI questions, enter inflation. The math on those valuations starts to unravel fast. The AI narrative is shifting from tailwind to headwind. For the past 2 years, artificial intelligence was the single most powerful force lifting the stock market. The story was simple. AI is transformative. The companies building it will be enormously valuable, and investors should own them aggressively. That story drove the Magnificent Seven: Nvidia, Microsoft, Apple, Amazon, Alphabet, Meta, Tesla, to dominate the S&P 500 and pull the entire index higher. That story hasn't disappeared, but it has gotten considerably more complicated in 2 separate directions simultaneously. Direction 1. AI as a cost center, not yet a profit center. The top 4 hyperscalers, Microsoft, Amazon, Meta, and Alphabet, are expected to pour a combined $700 billion into AI data center equipment. However, capital expenditures come with significant risks. The data center hardware being purchased will eventually age and become obsolete, recorded as depreciation that could become a long-term drag on earnings. Furthermore, the market is beginning to punish AI spending, with Amazon and Oracle shares down 7% and 24% respectively year to date. As investors get nervous, the motley fool. Direction 2. AI as a potential long-term growth driver. Optional hint to complexity. Investors are now scrutinizing AI spend more carefully than ever. Even companies with strong earnings are seeing immediate stock reactions. The AI story is no longer a simple upward tailwind. It now has layers of complexity, immediate costs, potential obsolescence, and investor sentiment risk. AI spending can drag on earnings for years, even if the long-term payoff is large. Amazon and Oracle are early examples of market impatience. AI investment creates uncertainty that investors hate. Shares react not to long-term potential, but to immediate perception of risk. Understanding this is crucial to reading today's market. The concern, as analyst Jim Cramer framed it, is that Nvidia's largest customers cannot keep spending at such a blistering pace unless they start to see a big increase in profits from their AI efforts. In other words, where's the return on investment? Companies have spent hundreds of billions on AI infrastructure. Investors are now demanding to see revenue. That patience is running thin. Direction 2. AI as a disruptor of existing businesses. This is newer and arguably more rattling for the broader market. Fears of AI disruption continue to weigh on markets. A report published by Citrini Research laid out hypothetical scenarios for how AI could disrupt parts of the economy. Stocks mentioned in the report tumbled immediately. American Express sank 7.2%, DoorDash and KKR fell 6.6% and nearly 9% respectively. Software stocks have been among the worst hit, with the S&P 500 Software and Services Index down almost 24% so far this year. The declines come amid concerns about companies' soaring AI capital expenditures and their ability to meet increasingly high earnings growth expectations. U.S. stocks face challenges from a shift in the AI narrative, from opportunity to threat, particularly impacting software and technology sectors. The sector rotation away from technology toward energy, materials, and consumer staples reflects this changing dynamic. So the AI trade that carried the market upward for 2 years is now creating turbulence in both directions. AI infrastructure spending is questioned for its return on investment, and AI capabilities are now threatening the business models of established software and services companies. The market is repricing both sides of that equation simultaneously. Investors are watching AI spending closely, while also monitoring its disruptive potential. Short-term market reactions often overshadow long-term potential. Understanding this dual dynamic is crucial for navigating today's AI-driven market. If the AI narrative shift is the slow-moving pressure on markets, tariff policy is the acute volatility trigger, and February and March of 2006 have been defined by it. Here's what happened. President Trump had imposed sweeping tariffs using emergency powers authority. The Supreme Court struck down those tariffs, ruling that the president had exceeded his authority. Over the weekend following the ruling, Trump announced he would hike tariffs to a new level of 15% on imports, using different legal authority. CNN. The Dow Jones Industrial Average dropped 821 points on the Monday following that announcement. The S&P 500 shed 1.04%, and the Nasdaq declined 1.13%. CNBC. But here's the deeper problem, and it's more important than any single tariff rate. The market can price a tariff. It can model what a 15% levy on imports does to corporate margins, consumer prices, and GDP growth. What it cannot price is uncertainty, the condition of not knowing what the rules will be, how long they will last, or what comes next. As one senior market analyst put it, while the direct impact of tariffs may prove temporary from a monetary perspective, the lack of clarity regarding their duration and scope keeps volatility elevated. Studies conducted by the Congressional Budget Office, the Federal Reserve Bank of New York, and the National Bureau of Economic Research have arrived at the same conclusion. U.S. businesses and consumers have paid roughly 90% of the tariff cost, with each dollar collected being money that could have been spent elsewhere in the economy. The combination of tariff uncertainty and market reaction is creating acute volatility. February and March 2026 have been defined by this chaos. And tariffs don't just affect import costs. They affect supply chains, capital investment decisions, corporate planning horizons, and currency dynamics. Analysts generally attribute the decline of the US dollar index, which fell 8% last year, to Trump's trade policy, which erodes the relative attractiveness of US assets to international investors. UBS downgraded American equities to benchmark, citing mounting risks from a weakening dollar, stretched valuations, and policy turbulence in Washington. Historically, when the dollar's trade-weighted index falls 10%, U.S. equities underperform by roughly 4% in unhedged terms. The result: global capital is rotating away from U.S. equities. The MSCI World ex-U.S. Index has gained about 10% in 2026, compared to the flat performance of the S&P 500. A gap the S&P 500 has not seen in 30 years, according to Charles Schwab strategist Kevin Gordon. International investors aren't abandoning U.S. markets because earnings are bad. They're reducing exposure because U.S. policy is unpredictable. Tariff volatility, dollar weakness, and policy unpredictability are creating cross-currents in global capital flows. Investors are reacting not to earnings fundamentals, but to risk and uncertainty in U.S. policy. This dynamic explains why international capital is favoring stability over U.S. returns, despite strong earnings. The fifth force, tying everything together at the macro level, is inflation, refusing to retreat and threatening the Fed's ability to cut rates. On February 27th, the January PPI report signaled inflation remains untamed. Headline: PPI climbed 0.5%, core PPI 0.8%, above consensus of 0.3%. This dashed hopes for a Fed rate cut in H1 2026. Investors repriced the terminal rate, fearing further hikes if services sector inflation remains sticky. The 10-year Treasury yield responded, pushing toward 4%, further squeezing equity valuations. When bond yields rise, the present value of future earnings falls. High growth, high multiple stocks are most sensitive. Their valuations depend on discounting large future earnings back to today. Rising discount rates make future earnings worth less, dropping stock prices, even if businesses perform well. S&P 500 trades at 22.2 times forward earnings, above 5-year average of 20. Wall Street expects 15% earnings growth in 2026. If results fail to meet expectations, the market could decline sharply, especially with elevated valuations. Earnings are strong, but they must grow exceptionally to justify prices. Sticky inflation keeps the Fed on hold, rates elevated, applying mathematical pressure on high multiple stocks. Unemployment is rising from 4.0% to 4.4%, with job growth slowing to 50,000 per month. This combination of cooling employment and stubborn inflation is the macro squeeze investors fear. Not enough growth for high multiples, but not enough weakness to force the Fed to cut. Inflation data continues to surprise above expectations, keeping markets cautious. Investors are watching bond yields closely as higher rates reduce equity valuations. High-growth tech and AI stocks remain most vulnerable to rising rates. Even strong earnings must exceed high expectations to maintain current prices. The Fed is constrained. Inflation prevents cuts. Employment slows growth. Mathematical pressure on valuations is building for every high multiple stock. Investors face a narrow path. Strong growth is needed to justify prices, but macro constraints limit that growth. Let's put all 5 forces together. The market is falling despite strong earnings because valuations were historically stretched entering 2026. The AI narrative has shifted to a two-sided story of uncertain ROI and disruption. Tariff policy is unpredictable and costly, driving international capital away. Inflation remains sticky, keeping the Fed cautious, and the market is pricing all this uncertainty into asset prices. Strong earnings aren't enough when the future is uncertain. A smart approach: accumulate long-term positions in blue-chip stocks while keeping ample cash. Diversify geographically. Avoid chasing high-multiple AI names blindly, and keep a long-term perspective. History shows that disciplined investors capture the rebound after corrections. The market isn't broken, it's recalibrating. Understanding why is the first step to navigating it.